Thank you all for coming. My name is Jett. I'm the first vice president here at the FCC, and I'm so glad to see a crowded room on our last day of mask wearing in Hong Kong. Yeah, a round of applause for that, I think. Before we get started, just a couple of reminders. Please silence your phones. And I want to also let you know about a couple of events we have coming up. One is a club dinner tomorrow night, actually. If you haven't seen our wall exhibition downstairs, I think today might be the last day, so be sure to check it out. It's called Meme the News. And it's a collection related to the mask mandate. It's a collection of online content from various content creators on Instagram and other social media platforms about our experience during the pandemic here in Hong Kong the last few years. It's really worth checking out. And we're going to have a dinner related to that exhibition tomorrow night. Also coming up next week on the 9th, we have a club lunch with George Yeo, the former Singaporean Minister for Foreign Affairs. And also next week, the 13th, or maybe the week after, we have an encore screening of a documentary called No Ordinary Life. This is a documentary about 5 pioneering war camerawomen at CNN. So if you didn't catch it the first time, here's another chance. But for today, we're very pleased to have Weijian Shan with us again here at the FCC. I don't think he actually needs much of an introduction, but I'm going to give a brief one anyway. This is actually his at least 3rd time speaking at the FCC. He previously came here to speak about his books Out of the Gobi and Out of the Gobi and Money Games, not to be confused with Money Machine, which is the book we're talking about today. And today he is here to talk about his 3rd book, and I believe this is his first public event tied to this book anywhere in the world. So we're very lucky to have him here with us today. Just a few words. Mr. Shan is co-founder and executive chairman of PAG, a leading private equity firm in Asia. I think we have some representatives here in the room today. He was formerly a partner at another private equity firm, TPG, and co-managing partner of TPG Asia, which was formerly known as Newbridge Capital. Before working in private equity, he was a managing director at JP Morgan and a professor at the Wharton School of the University of Pennsylvania. And as we mentioned, he is the author of 2 previous books, Out of the Gobi and Money Games. So I think our best questions today are probably going to come from the audience, but I'll just ask a few to start off, and then we will open it up to the floor.
Thank you, Jennifer.
Yes, and thank you so much for coming. Let's please give him a round of applause.
Thank you so very much. I'm very honored, very humbled to be here. Thank you.
So the book is about Newbridge Capital's deal to acquire a controlling share in Shenzhen Development Bank, which to this day is the first time a foreign investor has been able to achieve that. So just to start, could you tell us a little bit about how you came across this opportunity and what was significant about it?
The opportunity came to us. And there was some background to it. The background was, as I described in my 2nd book, Money Games, Newbridge Capital, which was based in San Francisco, a US private equity firm, did a landmark transaction in Korea in 2000. Negotiation actually started in 1998. It was in the middle of Asian financial crisis, which began on September the 2nd, 1997, with the devaluation of Thai baht, the currency, which swept across Asia. And in October of that year, 1997, it came to Hong Kong. In fact, on the date of October 23rd, 1997, Hang Seng index, the stock market index, dropped, you wouldn't believe it, 16% in one day. And that was probably the peak of Asian financial crisis. And in Korea, the crisis bit very deeply. About 150 banks failed in that year, including what used to be the largest bank in Korea called Korea First Bank. So that bank was nationalized by the government. And then by the end of that year, the IMF came to the rescue of Korea, which was running out of money. By the end of 1997, Korea had only $8.9 billion in foreign exchange reserves left in its coffers, which would last probably about 2 to 3 days at the rate of capital flight at that particular time. And Korean public was encouraged to sell their jewelry to help the central bank to support its reserves. Of course, that wouldn't help very much. So IMF came in, provided a rescue package of $58 billion to help Korea under the condition that at least one of the banks, nationalized banks, including Korea First Bank or Seoul Bank, which is another bank, would be sold to a foreign investor. The idea was that Korea didn't have a credit culture. Credit culture meaning that you make loans on the ability of the borrower to pay the loan back, as opposed to on relationships, on government policy. And Korea lacked a credit culture, and multinational institutions thought the best way to bring in the credit culture was to sell one of the banks to a foreign investor. So we acquired Korea First Bank after many, many months of negotiation, as I described in my second book, Money Games, and we closed the deal in 2000. And then at about that time, China began its own banking reforms, because what ailed the Chinese banking system were very similar. I use plural here because many things ailed the Chinese banking system were very similar to the problems that the Koreans faced. So China, for example, in 2002, when this opportunity first surfaced, actually, as I described in the book, this opportunity surfaced on April the 1st, 2002, when somebody visited my office and told me about the possibility of acquiring this bank. In that year, PBOC, People's Bank of China, which is the central bank, estimated that the bad loan ratio in the Chinese banking system was 30%. Now, for any normal bank anywhere in the world, the regulatory requirement for capital of a bank was about 8%. Now it's more than 10%. So if your bad loan ratio is more than 30%, that means your bank is technically insolvent, right? And Standard & Poor, which is the international rating agency, estimated in 2002 that the total amount of bad loans in the Chinese banking system was more than $500 billion. Now, to put that into perspective, today, China's GDP is about $18 trillion. But at that time, in 2002, it was $1.1 trillion. So $500 billion, actually more than $500 billion, was about 50% of China's GDP. That was how broken the Chinese banking system was at the time. So S&P, Standard & Poor, estimated that to bring China's bad loan ratio, the banking system's bad loan ratio, from 30% to 5%, it would take at least 10 years, possibly 20 years. Again, remember, this was 2002. So it was around that time that China began to reform and restructure its banking system. It was against this background, in this context, that somebody came to me and said, are you interested to look at the possibility of buying control of a Chinese bank? Why did he come to me and to us? Because we acquired the control of this Korean bank, Korea First Bank, and successfully turned it around. The bank lost substantial amount of money, Korea First Bank, in 97, 98, and 99. And the first year we took over control of that bank, the profit was reported to be $200 million US. So we quickly turned around that bank and set it on the path of profitability. And therefore, we did have the credentials to buy a broken bank, turn it around. And at the time, Shenzhen Development Bank was very troubled. So the person, a lawyer who came to me, was in discussion with this particular bank, SDB in Shenzhen, and thought we had the credential, we had the experience, and we also knew China, and therefore we were probably the best candidate to approach, and that's how it came about. Sorry about this long-winded background of how this opportunity came to us.
And what did you think when the lawyer came to you? Did you feel like this was something that was possible?
Well, I said, no, of course not. I mean, this has to be one of the worst banks in the world. In the Korean context, even though we bought a failed nationalized bank, the deal with the Korean government was what we would call government-assisted transaction, meaning that the government took over the responsibility for all the legacy bad loans. We had the right to sell any of the legacy bad loans to the government at the original face value, which we call par value, right? So even though we took over a failed bank, we didn't take over the losses embedded in the bad loans of that bank. But in the Chinese context, the government was not going to provide you with any assistance at all. You had to buy any bank or that particular bank on as-is basis. And then, of course, we would be worried about how much bad loan there is, and what is the capital hole. Will we be able to save this bank? Will it go bankrupt? And when we first looked at the numbers, we thought this is impossible. If we put money into this bank, it would be like putting money into a dark, deep hole. We will never see our money back. So it was not an easy decision to make. In fact, last Sunday, I was having lunch with somebody, a German friend of ours, Johannes, and he said, I gave him a copy of my book. He said, honestly, Shan, when you bought this book, he was at Deutsche Bank. I thought, you are certainly going to lose money this time. We made a lot of money out of this bank.
So given all of that, what made you want to do this?
The important thing was it was a very rare opportunity to buy control of a national bank, a nationwide franchise, banking franchise, which is rare in any country in the world. You go to the United States as a private equity firm, if you want to buy control of a bank, that's against the law. It's not possible. The Bank Holding Company Act of 1956 says no non-bank institution can buy control of a bank or more than 25% of a banking institution. In China, the regulation was and remains so today that no foreign investor can buy more than 20% of a bank. And no foreign investors collectively can buy more than 25% of a bank, which is consistent with the Bank Holding Company Act of the United States. So we were able, in Korea, no foreign equity investor, a private equity investor, could buy more than 10% of a bank. We were able to buy control of Korea First Bank because it was under a special situation. The circumstances were Asian financial crisis. Korea was running out of money, and Korea needed somebody to help save its banks. So in China, ordinarily would not have been possible. But this bank had one very interesting feature. As I said, banking regulation would not allow anybody to buy more than 20% of the bank. With 20% of the bank, it wouldn't be able to buy control. But SDB, Shenzhen Development Bank, was the first company ever to go public on Shenzhen Stock Exchange. It's not only the first bank, but first company to go public on Shenzhen Stock Exchange. And today, it carries the ticker number of 000001. So it was the first one to go public. As such, its shareholding is extremely dispersed. At the time, the public float, what we call public float, that is shares held by small investors, small shareholders, 100 here, 1,000 there, the public float was 72%. And the Shenzhen government owned less than 20%. But that made them by far the largest shareholder, and therefore they had the control of the bank. They appointed the entire board of directors, other than the independent directors. I think they appointed the independent directors as well. And then they appointed the entire management. So what was presented to us was, if you buy the shares less than 20%, about 18% from the government, you would get all these rights to control this bank and to be able to form a board, with enough directors that you would control the board. Then you will be able to appoint all the senior management of the bank. And we were very confident with one thing, and that is risk management. Because the reason that the Chinese banks have so much bad loan on their books is because they were just giving money away to borrowers, and there was no concept of risk management. So that was the source of the problem. But if you know how to manage the risks, if you only lend money to what we call credit-worthy borrowers, that is, those borrowers who have the ability to pay the money back, then we thought, and the reason I entitled this book as Money Machine, we thought the Chinese bank could be turned into a printing machine of money. And the reason for that is, in any other markets, banking is very competitive. So the lending rate is set by banks, and you want to set no higher than your competitors, otherwise good borrowers will not borrow from you. Then you need to attract deposits from customers like you and myself, and you want to set the deposit rate as high as possible to attract deposits into your bank. You use the money collected from deposits to lend to borrowers. And the interest rate differential between the deposit rate that you pay and the lending rate that you collect is called spread. And the spread usually is very thin, about 1%, 1.5%. That's how banks make money, right? They just make 1 or 1.5%. Very thin margin. But in China, it was very different. The interest rates were set by the central bank, PBOC. You cannot collect deposits by paying an interest rate higher than what PBOC set. You cannot lend to a borrower at an interest rate lower than what PBOC said. So the spread was about 3.5 to 4%, compared with about 1 to 1.5% in foreign countries. So I thought, wow, this is a license to print money, right? No matter how competitive or how much competition there is in the banking system, your spread is guaranteed by the central bank. And that was something that didn't exist anywhere in the world. The trick is, if you throw money away, then that spread doesn't help you. And that was the problem with the Chinese banking system. And we thought we knew how to manage the risks because we developed a similar system in Korea. And we thought if we could use this system in China, we could also make a lot of money from whatever bank we control. The key was control. If you didn't have control, obviously none of this would happen. And as it happened, that this bank would allow us to buy control even with our ownership less than 20%. So we thought this is worth looking into.
So once you started pursuing this deal, there was no regulatory precedent for it, for a foreign investor to acquire a controlling stake. So what kind of reception did you get when you started meeting with government officials, and what role did regulators and government officials play in helping this along and figuring out how to get it done?
Well, to start out with, we have to remember that 2002 was 1 year after China's accession into WTO, the World Trade Organization. And the buzzword at that time was reform, economic reform, and then to converge with international best practices. So banking reform was part of it. And China was shielded from the storms of Asian financial crisis in 1997-98, even though its banking system was very weak, because China's capital market was closed. So there was no capital flight. Korea, Indonesia, Southeast Asian countries, all the Asian countries, including Japan, got into trouble during the Asian financial crisis because of capital flights. Foreign capital was leaving the country. But because China had capital controls, there was no capital flight. But that didn't mean that the banking system was healthy. To the contrary, the Chinese banking system was among the weakest in Asia. So I think the leaders at the time, Zhu Rongji was the prime minister of the country, fully realized that the banking system had to be restructured and had to be healthy. So that was very much on the agenda of the central government. You remember they created 4 large so-called asset management companies, such as Xinda, such as Oriental, each one of which corresponded with one of the 4 major largest state-owned banks: Bank of China, CCB, ICBC, and Bank of Agriculture. And the AMC's asset management companies took all the bad loans out of their corresponding banks, so that there was one sweep carve out of all the bad loans from all the major banks, financed by the Ministry of Finance. And then China set up a new regulator called CBRC, that is China Banking Regulatory Commission, splitting off one bureau from the central bank to form this regulator. And their job was to restructure the banking system together with the central bank. And CBRC actually made the requirement all Chinese banks had to bring in some foreign investors, all of them without exception. The idea was not to bring in capital. The idea, because China had enough capital, China had a savings glut, as it does today. Unlike in Korea, in Korea, in 1997, 98, I thought foreign investors were necessary devils because they didn't want foreign investors to come in, but Korea was running out of capital. China didn't have that problem because of high savings rate, but they wanted the foreign investors to come in precisely because they wanted to bring in this credit culture, risk management system, and international best practices. So regulators were welcoming any investors who have international experiences, best practices in banking. So I would say that from Shenzhen, the local government, all the way to Beijing, we were, I wouldn't say red carpets, but we were looked at very favorably. That doesn't mean that you would get the approval. And as it turned out, it was a very long, arduous process to eventually make this investment, as I described in the book. And throughout this process, so many times I thought there was not going to be a deal. I thought that the entire process was derailed.
That actually leads into my next question. The book is a really fascinating account of all the details of how this was accomplished. And there seemed to be so many times when it seemed like a deal was really close and then it fell through at the last minute and maybe came back later. How did you keep your emotions in check when things like that happened and when you're going on this roller coaster experience?
First, it was not personal. I was a partner of an American firm. I have other partners who would give me a shoulder to cry on, I suppose. But I didn't have to do it. I remember that in the middle of negotiation for Korea First Bank in Seoul, and one of the sessions became very emotional. And I was a little upset because I thought the other side backtracked on something that we had agreed before. And then our advisor from Lehman Brothers, at that time, Lehman Brothers was still a leading investment bank, and he was the head of FIG, Financial Institutions Group. And his name is Michael Hanlon. He pulled me aside and he said, Shan, this is not personal. And I immediately realized that he was absolutely right. So, in deal business, we experience ups and downs all the time. Sometimes you spend a lot of time to go after a deal, and sometimes it succeeds, and sometimes it fails. So you have to keep your emotion in check. My wife, when she tries to buy a home, if she falls in love with a home, I know there's no room for me to negotiate the price, right? So I always encourage her to find at least 2 targets, and then I know I can negotiate the price.
I'm just going to ask one more question and then we'll open it up. The book is so rich in detail in terms of the descriptions you provide. It often feels like you're in the room. And I was wondering, since a lot of these events happened quite a few years ago, what kind of journaling habits you have and what else you had to do to sort of reconstruct what happened. Like, you have a lot of descriptions, physical descriptions of people, their ages at the time, the impressions you got of them. And I was wondering if you recorded that at the time, because it's very journalistic. And I was just curious as to your actual process of reconstructing what happened.
I would say 3 things. Major events, I remember. And major days, I remember. For example, we closed the transaction on December 30th, 2004. And the bank was very broken. And by its annual reports of 2004, the bad loan ratio of this bank was 11.4%. This was about 20 years ago. And the actual bad loan ratio by our due diligence was twice as bad. And the capital ratio, nominal, that is reported, was 2.3%. The actual was negative. And the reported profit was $40 million for 2004. And we knew there shouldn't be any profit if the bank had made sufficient provision for its bad loans. So in 5 years, we brought the capital ratio to more than 10% real. And we brought the bad loan ratio back to less than 1%. And we increased the profitability from nominally about $40 million to more than $1 billion, all in 5 years. So these things I remember. And then I write emails to my partners and exchanging emails with my partners, especially David Bonderman, the founder of TBG. And I have all those emails. When I left TBG, TBG allowed me to take all my emails with me, and then I keep a very simple diary. That's why I can reconstruct each day of the events.
Well, let's take some questions. We have a couple of people with microphones, and please be sure to identify yourself and your organization, if any. We can start in the back there.
Thanks. Tony Watson, Far East Investment Management. To what extent was cost-cutting, operational efficiency part of your journey to profitability for Shenzhen Bank? And to what extent did you run into barriers, either regulatory, culture, whatever, in implementing new technology or laying off people or closing down redundant branches and things like that?
Well, details are provided in the book, so I would encourage you to read the book. I wouldn't say that our major focus was to cut cost. That was not a significant concern for us. The major focus, of course, was to stop bleeding, meaning not to throw money away. And that was to install a very good risk management system. But we discovered something very interesting within that bank. The credit decision making, that is, whether or not to make a loan, was not centralized at the head office level. The credit making decision resided with each of the branches, and this company has more than 200, about 300 branches throughout the country. So every branch manager had its own standard, whether or not to make a loan or not to make a loan. And as you can imagine, the loan quality therefore varied a great deal. So in some branches, the loan book was of very good quality, whereas in some others, there were many bad loans. And we decided that we had to really fire all the incompetent managers, and we need to promote those good managers who were making good quality loans. And that was part of the effort to restructure the bank. And it was not so much to save the costs, but to make sure that the best people were put into the best places or the right places. And eventually, of course, we revamped the decision-making process. We actually removed the credit decision-making power from all the branches and centralized them into the head office, so that there's one credit committee and one chief credit officer making all the major credit decisions, and therefore the quality of the loan is assured. It will be consistent. But when we were trying to make personnel changes, there was a lot of resistance, to such extent that there was threat of physical harm to myself and to some of my colleagues, as I described in the book, prompting our American colleagues, partners, to invite us to hide in the United States, which also described in the book. So that was the hard part. When it comes to make changes, I would say the regulators were very supportive, and sometimes they were very harsh. For example, our bad loan ratio was very high. And if the banking regulators enforce the 8% capital requirement, we would have become insolvent on day one, because our reported bad loan ratio, reported capital ratio was 2.3%. The regulatory requirement was 8%. So if the regulators said you have to be at 8% on day one, then we would have declared bankruptcy. They didn't do it. They practiced what I would call regulatory forbearance. So they really didn't enforce that requirement and gave us enough room to grow ourselves out of the problem. And this happened in the United States before. And we actually talked with the regulators about this before we took over control of the bank. In the 1980s, Bank of America got into trouble for their exposure in Mexico and Latin American countries. So they were capital inadequate. The Federal Reserve System practiced regulatory forbearance, didn't enforce the capital requirement, and therefore allowing Bank of America to basically dig themselves out of the hole over a period of time. And that's what regulators did in China as well after we took over control of the bank. But in 2008, something extremely unusual happened. When you have a bad loan, you're supposed to put some reserves, or what we call provision, against that loan in preparation for that loan to be written off. So let's say the bad loan is 100 million US dollars, and you think that at least half of it will go, you will not be collected. You will have to put aside $50 million from your capital or from your profit against that bad loan, and that's called reserve ratio, 50%, for example. Now, when Liu Mingkang, the chairman of CBRC, was chairman, in 2008, he imposed a rule that the coverage ratio had to be more than 150%. 150%. Usually, in any other countries, 50% would be adequate, because you don't expect a lot of bad loans to completely go to zero. You may lose half of it, but you will be able to collect some of it. But he was not even content with 100%. He wanted 150%. Eventually, the average went up to 200%. Average meaning for the entire banking system in China, the bad loan coverage ratio went up to 200%. Then you think about it, there's no point for you to keep any bad loan. If you have one bad loan, you have to set aside, if you have $1 bad loan, you have to set aside $2 in capital against it. So that one move forced us to write off our entire bad loans in 1 year, in 2008. And that was a shock to the market. So when I think about the difficulties that we had, that was one of them. But that eventually saved this bank. Our bad loan ratio immediately came down to less than 1%. Another thing was, as I described in the book, the ability to raise capital. From day one, we tried to raise capital because this bank was undercapitalized. But there was a conflict between CBRC, that is banking regulator, and CSRC, that is securities regulator. CBRC wanted us to raise capital, as much as capital. as much as possible because they are concerned about the safety and health of the bank. CBRC wants us to raise capital. CSRC, the Securities Regulatory Commission, didn't want anybody to raise capital in the capital market because they're afraid that if you issue too many shares in the marketplace, that would depress the stock market price. Their role is to make sure that the stock market will maintain a certain level. So two regulatory agencies give us different guidance. And eventually, for a number of years, we were not able to raise any capital. So all of those things are discussed in my book. But that's a very good question. We never focus on the cost cutting so much because we really grew. We grew this bank by 4 or 5 times in about 5 years' time. We eventually grew out of our cost base. Initially, our cost base was too large, but we grew our assets to fit the oversized clothes. And cost cutting was not the issue, but restructuring and personnel changes were very much part of the reform plan.
Other questions? Yes, right here.
Hi, Mr. Shan. Thanks very much for sharing. My name is Flora Wang. I'm from Fidelity International. I'm just wondering if you were given the opportunity today to acquire another bank in China, if you can just put aside all the regulatory restrictions around private ownership of banks in China, which bank would you pick? And if it's really slim pickings in the banking sector, which sector in China today is most interesting to you as an investor?
Thank you. That's a very good question. I wouldn't buy a bank anywhere in the world today. Banks are too expensive to operate after 2008. You see, it's very interesting that in 1997, 98, we call it the Asian financial crisis. So many banks failed, from Korea to Japan to Indonesia in Asia. And then many countries went into banking reforms, starting from Korea, and then Japan, Indonesia, and then to China, right? And when 2008, the Atlantic financial crisis hit, Andrew gave me this name, otherwise known as global financial crisis. I object to the usage of that term because that financial crisis didn't really affect banks in Asia. None of the banks in Asia failed. It was really a crisis hitting American banks and European banks. And Andrew had a friend who coined the term the Atlantic financial crisis to describe the 2008 financial crisis. But when that crisis came, none of the Asian banks failed because all of them were restructured, all the countries restructured, reformed their banking system. So by and large, Asian banks were very healthy, including the Chinese ones. But after that, Basel, which is the International Bank of Settlement, international banking organization supported by all the banks in different countries, they are responsible for setting rules, how much capital you should have for each of the banks. And now, for example, the capital adequacy ratio is 10%. The cost of running a bank was substantially increased after 2008. Capital ratio is substantially increased from 8% to 10%. And I think for banks here in Hong Kong, the average is probably more than 12%. And for banks in China, it's probably even higher, maybe 14%. It's very difficult to make return on capital if your capital base is so big. From 8% to 12%, that's a 50% increase. More than that, the compliances requirements are enormous. And that is, you will have to have teams of lawyers, armies of lawyers to look after this compliance issue and that compliance issue. That's extremely costly. And then the bad loan coverage ratio is increased, so you have to set aside a lot of capital for that. So today, running a bank costs twice as much as doing so, let's say, before 2008. So before 2008, if you could buy a bank at what we call book value, net asset value of the bank, it would have been considered to be a steal. Today, I think I would buy a bank at probably 70 cents, 70% of net asset value, and I would still consider it too expensive. Because if you want to make 15% return on capital, on the capital that you put in, if you buy at the book value, net asset value, you wouldn't be able to make 15%. Maybe you can make less than 10%, single digit. So because running a bank is so expensive, it's not a profitable business anymore. And of course, interest rate, until very recently, came down so substantially, making the interest rate margin very thin. So I wouldn't buy a bank today, either in China or anywhere in the world. Sorry.
Which sector would you be interested
Which
in?
sector would you be interested in today, in China specifically?
It's not a matter of sector when it comes to making investments from the point of view of private equity investor. For example, you would like to invest in sectors which is not super competitive, because it's very difficult to make money if the sector is very, very competitive, right? Cutthroat competition. So when you think about it, there's one very competitive industry that I can think of, let's say in the United States, that's coffee shops. Every street corner, there's a coffee shop, right? Every block, there's coffee shop, there's cafe. So you would think that this is a sector that you don't want to invest because it's too competitive. It's hard to make money. But there's a Starbucks, which charges a premium price and which becomes a very large scale operation, right? It's not so much of the sector. It's to what extent your operation differentiates from your competition. Do you have a brand name? Do you have a product that is special or perceived to be special? We recently invested in a company which is franchise business, not only in China, but in the United States, Middle East, many different countries, called Percentage Arabica. Have you heard of it? IFC has a shop. And we claim that their coffee is better than Starbucks, much better than Starbucks. And I believe it because I don't drink coffee. I believe whatever they tell me. But just by the traffic, we know that coffee business is a premium business. It has very good brand, has very good products. It attracts a very loyal following. So it's not which sector that you pick, it's what business that you pick. Why do we like banking? Well, first, it's an industry of high entry barrier. Not anybody can set up a bank, right? The licensing requirement is such that that is Newbridge Capital, was the only foreign investor to have ever controlled the Chinese bank. There was none before, there was none since then. And that was a very high bank entry barrier, and that's why we were interested to look into it in the first place. So if in any industry you spot a business leader with unique product, with a very good brand, and then that's the kind of business that you'll be interested in, provided that the price is good enough.
I think we might have time for one more question, if we have any. Yes, in the back.
Hi, I'm going to take your mind off deal making for a while. One of the biggest headlines we've seen in newspapers recently is ChatGPT. While some universities globally, including some in Hong Kong and the States, have banned students from using ChatGPT in their assignments, there's this Wharton professor Ethan Mollick, I think that's his name, that requires students to use ChatGPT in their assignments for his class. So I was wondering what your instruction would be to your students if you were still teaching at Wharton.
With regard to ChatGPT?
Yes, ChatGPT. What would you ask them to do and why?
Well, I think, to my knowledge, all artificial intelligence to date is simply pattern discovery. And of course, machines can do a better job than humans since about 10,000 years ago, depending on what you do. I was a farmer for many years, and I knew using my bare hand, I wouldn't be able to plow a field, whereas with a plow, I would be able to do so. And humankind have progressed technologically over the years, and now we have this artificial intelligence. And I think the limit of artificial intelligence is it couldn't set a purpose for yourself. For example, you can play a game of chess with a machine, but as a human, as a person, I can simply smash the chessboard and throw the chair into the ceiling, right? The machine wouldn't know to do that because it was not programmed to do it. So I think that when it comes to setting a purpose and doing something, for example, I want to write a book. The machine wouldn't itself come up with the idea of writing a book. Somebody will have to tell the machine to do so. So I think the idea that artificial intelligence can replace human brain is overhyped, and I don't think that's possible. And I tested it. For example, now I have 3 books out. For the first 2 books, I wrote the Chinese version for each of the 2 books. I didn't translate them. I just rewrote the Chinese version since I know how to write Chinese. And I thought that translation would read very awkward, not by native speaker of Chinese. But I did attempt to use all kinds of artificial intelligence to translate my book. And I can tell you that none of them is any good. Otherwise, it would have made my job easier. So I think that we will continue to make progress with artificial intelligence. And artificial intelligence will get smarter and smarter, so to speak, but it will remain pattern discovery. It will not set a purpose, an objective for and by itself. And therefore, human ingenuity remains to set goals. And that's not something that machine will replace. So I wouldn't even care if my students use or not use ChatGPT. Maybe I won't be able to tell if anybody is cheating, but you have to learn. If you don't learn arithmetics, mathematics, and you start out by using a calculator from kindergarten, then what good does it do to you?
Well, I think we need to wrap up, but thank you so much for being with us today. That was really interesting. And all 3 books are available over here. The book we discussed today, Money Machine, as well as the previous books, Out of the Gobi and Money Games. Thank you again very much.
Thank you. Thank you very much. Thank you. Thank you.